Markets are gearing up for the November CPI due out tomorrow morning at 8:30 a.m. Eastern. Let's bring in Shannon Saccocia, Chief Investment Officer of Neuberger Berman Private Wealth, as well as a CNBC contributor. Shannon, I think you're starting to echo what we've heard from some other guests recently, that maybe the leadership is going to change, or at least that the big tech Mag 7 are extended, and maybe that we shouldn't expect that to be the market mover next year.
Yeah, Joe, this has been our call for much of this year. Obviously, we were a little bit early in the first half in making this call. However, if you think about just the compression that we anticipate in earnings for the Mag 7, that is going to create some vulnerability for those valuations. It's not that they don't have strong balance sheets. It's not that they're going to continue to grow. And it's not that the spending that they're doing won't necessarily equate to growth in the future. However, if you look at the rest of the large cap universe and then dip down into small and mid caps here in the U.S. as well, those earnings are expected to accelerate. Double digits for small caps next year. And so we just think that there's going to continue to be this rotation from a broadening out perspective. We also think that there's going to continue to be a thrust of cyclicality in the market, and those sort of lend to looking outside of large cap technology for exposure to that particular theme.
You like some of the policies, I think. Usually deregulation and business-friendly policies, there's some positive things I like, but we are talking about overall PEs at historically the high end of what we usually see. Maybe rates come down. I don't know. Maybe the Fed continues. But a multiple expansion doesn't seem like it's likely.
Yeah, and you've really seen, obviously, we've seen on the large cap side, Joe, you've seen the S&P 500 driven by both earnings growth and multiple expansion over the last 12 months or so. I do expect that, from our research that we're doing at Neuberger Berman, we are looking at the possibility of, lower rates, lower costs, kind of this disinflationary trend, certainly creating some lift on the bottom line. But really, it's on the top line. We anticipate that 2025 will be a year of above trend growth for the U.S. economy. And so if you think about the best driver, it's, sort of nominal sales growth. And we saw that during the inflationary period. And we think that we're setting ourselves up for, some continued earnings growth and improved earnings growth as a result of that nominal growth at the top line. That's where we see potentially some of these stocks growing into their valuations versus anticipating this seismic shift of multiple expansion that's going to drive the markets higher.
But you think non-U.S. markets are even more attractive at this point? Why is that if we continue to outperform as an economy?
Well, actually, how we think about it is really in terms of two halves in 2025. We do think that just obviously from a valuation perspective, valuations outside of the U.S. are much more attractive than U.S. stocks. However, they don't have the clear catalyst that we have in terms of concerted industrial policy, a stronger foundation upon which to jump off of. So what we see is actually a little bit of bifurcation. If you look in the second half of the year, for instance, for Europe, you could see lower energy prices based on, in part, some of what the Trump administration is focused on. You could also see potentially resolution in Ukraine. And then lower rates, the European economy, for instance, much more interest rate sensitive in this last cycle than what we saw here in the U.S. And so there are some catalysts potentially to justify investing in these more attractive valuations. But we do see them in the second half of the year. The last thing I would add, Joe, look at China. Think about some of the comments coming out of the Politburo this weekend. If we see, focus on what they're calling kind of vigorous support of consumption, that could also be a catalyst for China in the second half of the year.
The industrial policy, you've mentioned that a couple times and in the notes as well. I guess it depends on what you're talking about. A lot of things can qualify as industrial policy. In the Trump administration, which aspects are you talking about? I mean, I understand industrial policy, when there's for the last 4 years, but what about for the next 4 years? Where?
Well, Technically, Joe, I mean, unless you anticipate, which we don't, a full repeal of the highway bill, the Inflation Reduction Act, and the CHIPS Act, we don't actually expect full repeal. And even for the IRA, we don't expect there to be, we expect there to be large parts of that legislation that remain intact. Much of that money is unspent, and it's really targeted towards areas and constituencies that can meaningfully benefit. The other part of industrial policy is if you think about this continued emphasis on the protection from either from a national security perspective or just from a business perspective of U.S. industry, this idea that we're going to see continued reshoring that's going to be supported or perhaps catalyzed by the Trump administration trade policy, that also lends itself into our view that, the first part, the post-pandemic stimulus was really focused on the consumer. We think some of the legislation that's been put into place over the last couple of years that has longer tails is more focused on industrial revolution of, kind of policy spend. And so our view is that that's going to help support the manufacturing economy in the U.S., but also some of this more cyclical move on the equity side.